Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 2. This is Section G2. This is a remembering and understanding topic. Recognize the potential impact of lower complexity and higher complexity significant accounting estimates on the risk of material misstatement, including the indicators of management bias. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it's free, it's 1 hour, and in that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time studying. So make sure you check out that webinar, and after you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. In today's video, we're only going to be going over 5 questions, but SuperfastCPA Pro members get access to the full 10-question videos that we post in the members forum. So again, if you like this and you like our other products, make sure you check out becoming a SuperfastCPA Pro member so you can get access to the full 10-question versions of these walkthroughs. Now with that, let's go ahead and take a look at the questions for this video. All right, here we are at question 1, and something I always like to point out, this is a very good habit for test day. You want to read the last sentence or the last part of the question first. Again, it's not always going to be helpful, I've mentioned this before, but very frequently it will be helpful. And again, this is a great strategy for test day because when you read the last part of the sentence first or the last part of the question first, frequently it tells you what the question is about. It kind of gives you context for what the question is trying to teach you or trying to ask you. So you read that, and then you read through the rest of the question, again with that context already in mind, and that will help you answer questions more quickly. So let's go ahead and do that for this question. What is the auditor's primary responsibility regarding these estimates? Again, imagine you were on test day, you read that, you immediately know you're dealing with estimates of some kind, so that gives you a little bit of an idea of what you're dealing with. Now let's go up to the top. An auditor is evaluating an entity's financial statements and notices that management has made several significant accounting estimates. What is the auditor's primary responsibility regarding these estimates? Let's read through the options. Option A, ensure that management's estimates are free from all uncertainty. Option B, develop independent estimates to replace those made by management. Option C, evaluate whether management's estimates are reasonable and free from material misstatement. Option D, adjust management's estimates if they appear to be too conservative or aggressive. Okay, so what is the auditor supposed to do when it comes to noticing that management has made a lot of significant accounting estimates? What is the auditor supposed to do? Now, based on what we've talked about in previous videos or your just general knowledge, you might have a general idea of which one of these is the correct answer. So if you want, pause the video and think about it, but if not, that's okay. We're going to look at the explanation to start learning. So let's go ahead and look at that right now. Okay, here we are. The answer is C, evaluate whether management's estimates are reasonable and free from material misstatement. So, that makes sense. It would make sense that the auditor is not going to just change their estimates. Let's walk through the explanation. Auditors are responsible for assessing whether management's accounting estimates are reasonable and free from material misstatement. This involves considering the methods and assumptions used by management, assessing whether the estimates align with available evidence, and determining if they exhibit indicators of bias. However, auditors do not eliminate uncertainty from estimates, and that was option A. They do not replace management's estimates with their own, and that was option B. And they do not directly adjust management's estimates, and that was option D. Instead, they evaluate reasonableness and may suggest adjustments if misstatements are identified. So they might be able to suggest something, but they're not going to change the estimates for management. So, that's the responsibility of the auditor, is just to assess the reasonableness of the estimates. Now let's go to the next question. All right, here we are at question 2. And again, we read the last sentence first. I know it's kind of silly, but this is a very good strategy and habit for test day. Which of the following situations would likely require the most auditor attention? Okay, let's go up to the top. An auditor is evaluating an entity's accounting estimates for potential risks of material misstatement. So we need to read the options to see which of the situations will most likely require their attention or the most of their attention. So let's go through the options. Option A, a warranty liability estimate that has been calculated using the same historical percentage for several years with minimal changes. Option B, a fair value estimate for a complex financial instrument that relies on unobservable inputs and significant management judgment. Option C, a straightforward estimate for routine depreciation expense based on a fixed asset's expected useful life. Or option D, an estimate for utility expense accruals that is based on an automated formula using prior usage patterns. Okay, so which one of these is something that will be a high priority for the auditor, that they kind of want to look at this estimate and make sure that things aren't wrong or that management is using something incorrect to do the estimate or whatever the case is? So based on what we learned in the first question, you might be able to figure this out. If not, that's okay. Again, we're going to look at the explanation to learn about this. All right, here we are. The answer is B, a fair value estimate for a complex financial instrument that relies on unobservable inputs and significant management judgment. So this is something that the auditor would most likely focus on. Let's go through the explanation. Auditors focus on estimates that have a high risk of material misstatement due to complexity, management bias, or significant changes. So let's talk about that. Complex estimates, and that was option B. Estimates that involve subjective assumptions, unobservable inputs, or difficult valuation methods, such as a fair value measurement for illiquid securities, require more auditor scrutiny. These estimates often have a higher likelihood of material misstatement due to uncertainty and management discretion. So again, in these situations where there's something really complex going on with this estimate and it's kind of hard to follow, the auditor probably wants to look at that. Now let's talk about some other things that would make the auditor want to look at this. So there's also management bias. If management has incentives to manipulate certain estimates, such as provisions for losses or revenue recognition, auditors must assess whether estimates are reasonable and free from bias. And then finally, there's changes from prior years. If an estimate has been modified significantly, auditors must evaluate whether the change is justified and appropriately documented. So if you see an estimate that was completely different last year, you know it was significantly larger or smaller, or maybe they used something completely different to evaluate it this year compared to last year. Those are the kinds of things where the auditor is going to be like, well, why are you changing it so much this year compared to last year? And so they would want to take a closer look at that. In contrast, routine and stable estimates, and those were options A, C, and D, that rely on consistent historical data or automated calculations generally pose a lower risk and do not require as much auditor attention. That's not to say that you don't look at those still sometimes, but again, they are less of a priority than these things that we just talked about, where there's complex estimates, there's management bias, or there's big changes from prior years. Now with that, let's go to the next question. All right, here we are at question 3. Which of the following accounting estimates would an auditor likely consider low risk and therefore require less focus during an audit? So kind of recall what we just talked about in the previous question. Let's go through this. Option A, an impairment estimate for a newly acquired intangible asset that relies on management's future cash flow projections. Option B, a depreciation estimate for office furniture using the same straight-line method and useful life assumptions as in prior years. Option C, a revenue recognition estimate involving multiple performance obligations and significant management judgment. Or option D, a fair value estimate for a complex derivative instrument that has no active market and relies on proprietary valuation models. So again, based on what we learned in the previous question, I bet you could think about this, or you might already know the correct answer. But if you don't, maybe pause the video, think through this, and think which one of these is probably going to be lower risk than the other ones. And when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is B, a depreciation estimate for office furniture using the same straight-line method and useful life assumptions as in prior years. Okay, let's walk through the explanation. Auditors focus less on low complexity estimates that are, and we'll talk about the following, consistent with prior periods, and that was option B. If an estimate such as depreciation follows the same method and assumptions as in previous years and aligns with industry norms, it is generally lower risk. Now, another lower complexity one is if it's aligned with industry guidelines. When estimates are based on well-established industry practices, and that would be things like standard useful lives for assets, there is less likelihood of material misstatement. And then also things that are not subject to significant bias. Estimates that involve straightforward calculations and minimal management discretion, and that would be things like straight-line depreciation, you can't really change that very much or really at all, are less likely to be manipulated. So if you see situations where it's something that's pretty straightforward, it's consistent with prior periods, and it's okay that it's consistent with prior periods, it's not something that should be changing relatively frequently, then those are the kind of things that are probably low risk. In contrast, and again, this is kind of based on what we learned in the previous question, high judgment estimates, and that was options A, C, and D, require more scrutiny. Impairment estimates, and that was option A, involves subjective future projections. Revenue recognition, and that was option C, often requires complex judgment. And fair value estimates for illiquid instruments, and that was option D, rely on significant assumptions, each increasing the risk of material misstatement. So if you see something that's really complex or there's a lot of management discretion happening, those are the kind of things that might be a red flag or might be something that the auditor wants to look at because there's a higher chance of those affecting the financial statements through a material misstatement. All right, let's go ahead and take a look at the next question. All right, here we are at question 4. Why would an auditor perform a retrospective review of management's prior period accounting estimates? Let's go through the options. Option A, to determine whether management's estimates were completely accurate. Option B, to ensure that management consistently applies the same estimation methods every year. Option C, to adjust current period financial statements based on prior period estimate errors. Or option D, to assess whether there are patterns of bias or indicators of potential misstatement. Okay, so based on what we've learned so far, you could probably think through this. So if you need to, pause the video, think about this, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer, D, to assess whether there were patterns of bias or indicators of potential misstatement. So let's walk through this. This kind of makes sense because we've talked about this before in the other questions, except we haven't talked about retrospective, but it makes sense that this would be what a retrospective review is about. A retrospective review involves analyzing prior period accounting estimates to identify potential management bias or errors in estimation methods. Auditors perform this review to assess whether past estimates were reasonable and whether there are patterns of bias that could indicate a risk of material misstatement in the current period. So that's why you look at it. You look at it to see if there's patterns of bias, to see if there's lots of errors that they've had in the past so that you can know that for the current audit. Now let's talk about the other options. A is incorrect because it's not about complete accuracy. Estimates involve uncertainty, so the goal is not to determine if past estimates were perfect, but rather if they were reasonable at the time. B was incorrect because it's not about strict consistency. While consistency is important, the primary concern is whether changes in estimates are justified and free from bias, not whether management applies the same method every year without change. It's not a bad thing necessarily if methods slightly change. Where there's a red flag is if things change drastically or in a way that doesn't really make sense for the estimate. But, it doesn't have to be exactly consistent. That's not something that would necessarily make the auditor want to look at that super closely. And C was incorrect because it's not about adjusting current statements, and we've mentioned that before. A retrospective review does not result in direct adjustments, but informs the auditor's risk assessment for the current audit. Again, auditors are not going to make those adjustments based on prior year errors or even estimates in the current year, but it helps them for their risk assessment in the current audit. By reviewing prior estimates, auditors gain insight into how management forms estimates and whether any adjustments are needed in their audit approach. So this is something that auditors might do to try to understand the estimates and make sure that they understand it as best as possible so that they can have the most efficient audit possible. All right, let's go to the next question. All right, here we are at question 5. When evaluating management's accounting estimates, what is the first step an auditor should take? Okay, let's go through the options. Option A, obtain an understanding of how management developed the estimates. Option B, independently develop their own estimates to compare with management's. Option C, perform substantive testing on the final recorded estimates. And option D, assess whether management's estimates from prior years were accurate. Okay, so which of these things is something that the auditor is going to do first when they're trying to look at these management estimates? If you don't know, that's okay, but I think based on what we've learned so far, you probably could kind of think through this. So pause the video if you need to and come back when you're ready. All right, here we are. The answer is A, obtain an understanding of how management developed the estimates. And that makes sense why that would be the first step. Let's go through this. The first step in evaluating management's estimates is to understand how they were developed. And how do they do that? This includes examining the methods management used to make the estimates. It includes the assumptions and data sources they relied on. And it includes whether the estimates are consistent with prior periods and industry norms. Only after understanding management's process can the auditor effectively evaluate reasonableness, identify potential bias, and determine appropriate audit procedures. And we've talked about those things throughout this whole video. So again, to be able to do that, you have to understand how management got to the estimate that they're at. Let's talk about the other answers. B was incorrect because developing independent estimates may be a later step, but is not done first. Option C was incorrect because performing substantive testing is part of evaluating the estimates, but comes after understanding how they were made. And then option D was wrong because assessing prior year estimates is important, and that's a retrospective review. We talked about that in the last question, but is not the first step in evaluating current estimates. So again, you need to understand how they developed the estimates, and then you can review the prior year stuff, or you can make your own estimates, or you can perform substantive testing to, increase your understanding or to kind of make sure that you understand the reasonableness of the estimates. But the first step is understanding how they got the estimates. By first gaining an understanding of management's estimation process, the auditor can then determine the appropriate level of testing and assess the risk of material misstatement. And with that, we've learned a lot in just 5 questions about estimates in this video. Before we do anything else, let's do one more part of the SuperfastCPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you what the auditor's responsibility is when it comes to management estimates, or whatever the case is. Again, whatever you're noticing most in the questions, you write these out as pillar topics in your own words. And as you're doing this each day, you're building your own personal repository of the most important things you learned from the questions in your own words so that you're ready for the exam. With that, let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, let's talk about auditors' responsibility for estimates. Auditors are responsible for evaluating whether management's accounting estimates are reasonable and free from material misstatement. They do not replace management's estimates, but assess their validity based on available evidence and risk factors. Now let's talk about high complexity versus low complexity estimates. Auditors focus more on high complexity estimates, such as those involving significant judgment, unobservable inputs, or a high risk of management bias. Low complexity estimates, such as straight-line depreciation or fair value estimates for actively traded securities, typically require less scrutiny. Let's talk about retrospective review of estimates. This is a great tool. Auditors perform retrospective reviews to identify patterns of bias or errors in management's prior period estimates. If past estimates consistently favored management, this could indicate a risk of material misstatement in the current period. Let's talk about the steps in evaluating estimates. And again, the most important thing that I wanted to teach you was the first step. The first step in assessing estimates is to understand how management developed them, including the methods, assumptions, and data used. Only after gaining this understanding can the auditor perform further testing, such as reviewing subsequent events or developing an independent estimate. Again, first step is understanding how they did it. And then finally, let's talk about procedures after understanding management's process. Once the auditor understands management's estimation process, they perform additional procedures, such as reviewing subsequent events, for corroboration, testing the data and methods used, and developing an independent estimate or range for comparison. Now with that, those were the pillar topics, and we've gone over the 5 questions for this YouTube version of the video. Remember, Superfast CPA Pro members are going to get access to the full 10-question version of the video that I'm about to finish making after this. So if you liked this, make sure you check out becoming a Superfast CPA Pro member, because again, you'll get access to the full 10-question walkthrough videos when we post them in the member forum. And the easiest way to become a Superfast CPA Pro member is actually to go watch the Superfast CPA training webinar on SuperfastCPA.com. In that 1 hour, we will teach you the key ingredients to passing the CPA exam, and I'm sure you're going to want to learn more. And again, that is the best path to becoming a Superfast CPA Pro member, so start with the webinar. Now, if you liked the video and you found it helpful, make sure to like it and leave a comment. I do hope this was helpful, and I will see you in the next video.